all cycles. So now let's talk about management assertions about account balance. So remember, these assertions are assertions that essentially the management is making about the amounts recorded in the balance sheet, right? Because that's where our account balances are, right? At month end, year end, we close out the income statement to the balance sheet. So the balance sheet is what's carried forward every year from one year to the next, right? So management's making assertions that the amounts that are recorded in the balance sheet exist. We do have cash. Management said we do have inventory. We do have accounts receivable. They exist, right? We didn't make this up. So management's making assertion that all asset, liabilities, and equity accounts exist. Auditors' general audit-related objective, in general, what the auditors are going to try to do is to obtain evidence that these amounts do indeed exist, right? And so, for example, the auditor would let's say the auditor is looking at accounts receivable. So the auditor would get the accounts receivable age trial balance, select a sample of customers, account balances for customers, and confirm those account balances. And we'll talk more about audit procedures related to the account sales cycle when we cover that. But the confirmation is getting third-party verification from the customer saying, yes, we do owe XYZ company this amount of money. That's evidence that the account exists. A customer is not going to confirm an account balance if they don't owe you money. So that's strong evidence that the account does exist as of year end. Also, the auditor is going to test for completeness. So notice we assertion about completeness with respect to transactions. There's also an assertion about completeness related to account balances. And again, the auditors want to make sure, management asserting that every asset that should be recorded has been recorded. Every asset we own is reflected in the accounts. So it's complete. Every liability that we're obligated to pay is reflected in the accounts. So the auditor's making the client's making those assertions. The auditors want to obtain evidence that they are complete. So for example, with liabilities, shift gears a little bit, the auditor would be concerned that the client has accounted for all of their liabilities. So one thing that they might do is to do a search for unrecorded liabilities. Right? And a search for unrecorded liabilities would include procedures to determine that whether or not there are any liabilities that the client is obligated to pay that they haven't paid. So that would be a test that the audit procedure that an auditor would perform to ensure that liabilities are complete. So then the other thing with the other significant assertion would be assertions dealing with valuation and allocation. So if you think about the balance sheet and the accounts in the balance sheet, we have what we call contra asset accounts, right? So we have the allowance for doubtful accounts, we have inventory obsolescence, we have accumulated depreciation. If you think about accounts such as the allowance for doubtful accounts, for example, or inventory obsolescence, right? One of the things that's significant about those two accounts is the fact that they're estimates, right? Management has to estimate what they believe their allowance for doubtful accounts should be, right? So the reason for that is so that on the balance sheet, the accounts receivable account is reflected at its net realizable value. Remember that, right, from your financial accounting? You have to reflect accounts receivable at its net realizable value. So the auditor management is making these assertions that, again, those accounts are reflected at their net realizable value, and it's at the appropriate amount. So what the auditor is looking for to test their objective with respect to this assertion that management is making is that it's accurate, that it's recorded at the correct amount, that it's classified properly, there's cutoff, that it's recorded in the current time period, in the correct time period, that the account balances agree with the master file. So for example, that the auditor can reconcile, or there's evidence that the client has reconciled the accounts receivable, the amount recorded in the general ledger for accounts receivable to the accounts receivable subledger, or the amount that's recorded in accounts payable reconciles to the accounts payable subledger, so that that there's evidence that they agree. So that what the auditor is looking is to see that those detailed transactions have rolled up to the general ledger accurately. And then the realizable value of those assets are included at their net realizable value, such as accounts receivable, net of allowance for doubtful accounts, or fixed assets, net of allowance for accumulated depreciation. So with respect to that, some of the audit procedures that the auditor would perform would be to make sure that amounts that are included in the trial balance are accurate, right? So the subsidiary ledgers. The accounts receivable age trial balance is correctly classified, right? You should only see in accounts receivable trial balance accounts receivables or transactions resulting from sales to customers, not transactions with employees, not transactions with related parties, but only to sales to customers, that they're recorded in the correct period, right? So in the confirmation process, for example, the auditor might look at when transactions occurred. When did the sale occur? A detailed tie-in, they're going to ensure that the client has reconciled the detailed trial balance to the general ledger, right? So that the amounts that are recorded in the subsidiary ledger rolls up to the general ledger, and all reconciling items have been resolved. Same thing with cash. You have a bank reconciliation, right? Detailed information in the bank, from the difference between the bank balance and the book balance has been reconciled, and reconciling items properly identified and resolved. And then finally, rights and obligations would suggest that the client is saying these assets belong to the company. These liabilities are the obligations of the company. We haven't taken on any obligations for our CFO or any management or any employees, right? That it's all the obligations of the company. And so again, the auditor would look for evidence of that. So again, with confirmation of accounts receivable, for example, if a customer confirms, you're going to confirm that one, yes, the amount is correct, they owe us the money, and it's the company's right? They have a right to this accounts receivable because they engaged in this transaction with the company. Ricardo, did you have a question? Oh, okay. Any questions on that? Does it make sense? Right? So when you think about assertions, right, you think management assertions, as I said, are exactly the same. Regardless of, you're going to see these same assertions when we start to talk about the sales and collection cycle, or the acquisition and payment cycle. These assertions are going to be the same. As I said, what is going to change is the auditor's evidence collection procedures. What evidence are they going to collect? So also you want to think about, it's important to understand the assertions, because the assertions are the framework from which the auditor develops their audit